In a few short weeks, America's big technology companies, that includes Apple, Google, Meta Platforms, and others, will be releasing their earnings for the fiscal second quarter ended March 31st, 2024. And in those earnings releases, investors will be hearing a lot about revenues, earnings, and cash flows. In these earnings releases, you'll get to see a lot of different financial metrics. That includes things like revenue, which is just sales, gross profit, which is revenue minus the direct cost of selling inventory, such as the price of the inventory and sales commissions, operating income, which excludes a few other things, and finally, earnings before tax and net income, the latter being the ultimate definition of bottom line profit under generally accepted accounting principles, or GAAP for short. Now, generally speaking, media coverage tends to focus on net income as the ultimate measure of profitability, being that it is, under GAAP accounting, the final metric that you see at the bottom of the income statement when everything else has been subtracted out. However, a lot of investors actually focus on another metric much more than net income, that being free cash flow. If you spent any time on online investment communities such as FinTwit, you've probably heard the term free cash flow bandied about quite a bit. Investors who are into fundamental analysis or value investing tend to be very preoccupied with free cash flow, and with good reason. Because this, unlike GAAP net income, tells you actually how much cash is free to be returned to shareholders in the form of dividends and or buybacks. You see, net income, as defined under generally accepted accounting principles, it's a useful metric, but it has some flaws. Warren Buffett famously doesn't like the metric because it includes things like unrealized stock price fluctuations, which means that if a company holds shares on its balance sheet, the changes in those shares show up in GAAP net income, even if the company didn't sell. So these are basically just vicissitudes of the market that are being counted as part of profit under GAAP accounting. Using metrics like free cash flow in place of net income, that is, in place of what most of the media calls profit, can therefore be useful in determining how much cash can actually be returned from a company to you, the investor. So, what is free cash flow specifically? It's part of a family of financial metrics referred to as cash flow metrics that include things like cash from operations, cash from investing, and cash from financing. The three just mentioned are GAAP metrics, meaning that they have to be included in corporate financial reports according to the Financial Accounting Standards Board. In the United States, basically, it means that companies that are publicly traded are legally required to report these metrics. Free cash flow is a little bit different. It's a non-GAAP metric. Companies don't have to report it. However, investors are very interested in it, so a lot of companies do report it, and furthermore, even if a company chooses not to report free cash flow, they can pretty well bet that analysts at banks and hedge funds that are analyzing their shares are going to be calculating it manually anyways. Interestingly enough, there are actually two types of free cash flow that investors think about, one being a lot more commonly talked about with respect to stocks than the other. Nevertheless, both of them are worth mentioning. The first of these is free cash flow to the firm. That is the cash that is free to be paid out to shareholders and bondholders combined. That version of free cash flow, starting from net income, is net income plus non-cash charges. That includes things like depreciation, amortization, impairment charges, plus interest times 1 minus the tax rate. That is, we're counting interest here as something that can be paid out specifically to bondholders, minus working capital investment, that is the increase in accounts like accounts receivable, inventory, and other such things, minus capital expenditures, which includes things like major purchases of property, plant, and equipment. Free cash flow to the firm is the metric that you'd be most interested in if you were holding a company's bonds, or a combination of stocks and bonds, or maybe preferred shares. This version of free cash flow includes interest, so it's generally bigger than free cash flow to equity, which represents just the free cash flow available to common shareholders. And as for free cash flow to equity, that is net income plus non-cash charges minus working capital investments minus fixed capital investments, and in some formulations plus net borrowing, meaning that we count a sum that the company borrowed as a kind of positive cash flow that can be used to pay shareholders. Now, not all institutions that use metrics like this count net borrowing as a part of free cash flow. The reason being, debt sometimes comes with covenants saying that it can't be used to pay dividends or be used to pay for buybacks. However, at times, it can be useful to count net borrowing as part of free cash flow to equity. So how could you as an investor use free cash flow in your investment decisions? Well, an obvious time to use it is when a company you know reports GAAP earnings that include a lot of temporary stock price fluctuations. Let's say, for example, you hold a stock like Berkshire Hathaway. It's 2002. You know that stock prices are going down dramatically. Berkshire holds a lot of stock. Its earnings are probably going down dramatically. You know that without even looking at that year's earnings releases. However, you also know that that doesn't really reflect the operating performance of the business. In that situation, you might prefer to look at free cash flow in place of or in addition to the company's reported earnings, because those reported earnings are just going to be so heavily influenced by the prevailing stock market conditions. And what are some of the drawbacks of free cash flow? Well, free cash flow is certainly a pretty useful metric, but it does have some limitations. One of those being that it doesn't take into account depreciation and amortization. Previously, I described the canceling out of stock price fluctuations in the calculation of free cash flow, or the exclusion of them rather, as a positive, because it basically gives you a sort of profit metric that excludes the effects of stock market noise. That particular non-cash charge excluded in free cash flow is indeed a virtue. However, it also excludes depreciation and amortization, which are actually very instructive non-cash metrics because they reflect the decline in value of a real cash outflow that occurred in a previous period, and because it's on a depreciating asset, will never be recovered. Free cash flow is one of the more popular metrics to use in discounted cash flow valuation. A valuation method where you sum up the future cash flows generated by a company, either dividends that you actually receive or profits within the company that could be theoretically used to pay dividends, and discount them at an opportunity cost. GAAP earnings aren't always appropriate for this type of valuation because they include a lot of asset price changes that don't really reflect what the company can actually pay you, at least not on a regular basis. For this reason, free cash flow or other cash flow metrics like operating cash flow are usually used in discounted cash flow valuation. Discounted cash flow valuation is a very theoretically sound valuation framework that's definitely useful. If you want to know more about it, be sure to hit that like button and also hit the follow button because I'll be exploring it in detail in my next video. Till then, thanks for watching.